Today I had the pleasure of talking to David Garofalo, who is the head of Gold Royalty Corp and has been the head of many other gold companies and is a director currently of many other gold companies. And man, we had the opportunity to talk about the current state of the economy and how gold plays into that, the differences between royalty companies as well as junior and senior mining companies. And man, I learned so much from this conversation. I hope you guys are able to do the absolute same. If you have the opportunity and you're interested in it, make sure to check out GROY on the New York Stock Exchange, Gold Royalty Corp. And man, I was real nervous during this interview. I'm just gonna be point blank. And I hope you guys get a great bit of knowledge out of it as well. Look forward to hearing you guys in the comment section, and I'll talk to you guys on the next video. Cheers.
All right, everybody. I have the astute pleasure to welcome David Garofalo, who is the current CEO of Gold Royalty Corp. Now, David, you have an extensive list of companies that you have either been the president and CFO of and CEO of as well. Man, I'm a little bit nervous talking to you, man. I'm just going to be completely honest. You have a great.
Well, I'm nervous too. I'm nervous about talking to you. It's not good.
Far from, man. You're also an independent director of one of the other featured companies on the channel, which is our Eris Gold Corp as well. So you have a huge laundry list, and I'm super excited to talk to you and get a little bit of knowledge from somebody that is so prolific in the mining industry like yourself. So we'll get into a bunch of different questions today, but the first thing that I really want to know from somebody that has had so much experience like yourself, where do you see the economy today and how gold plays a big impact into that?
Well, we're in uncharted territory, in my view, in that the governments around the world, central banks more specifically, are coordinating their efforts in a massive amount of quantitative easing, which is to say they're printing fiat currency with reckless abandon. And I'd say that really started in the credit crisis about a dozen years ago or so, when for the first time the central banks actually started to talk to each other and coordinate their efforts to deal with what was at the time an unprecedented systemic failure in our financial systems. But they haven't stopped. We've had very, very low interest rates throughout this period. And now we're experiencing real rates in negative terms, but I'd say in some economies, we've actually seen nominal rates in negative territory as well. We've never seen that before. And so that's a massive amount of stimulus that's being introduced into the system. We're seeing a lot of fiscal stimulus as well across the world. So we're seeing a lot of debt strapped on at the sovereign nation level, which is unsustainable, can't be repaid, will have to be inflated away. And so the governments are all competing to debase their currency, preserve their export markets, and deal with this unprecedented level of debt that they've strapped on to deal with the pandemic, but also I think a slowing economy. Continued improvements in productivity have really caused us to enter into a deflationary cycle that we haven't experienced before. So that's what's really driving the monetary stimulus we're seeing. They're using old tools to deal with new problems. And just not working. And in that environment where you're seeing a massive amount of stimulus, a massive amount of paper currency being introduced into the system, gold is starting to shine again. And it has been shining. We've had a bit of a respite, where we've seen gold range trade for a year or two, but that's starting to accelerate again. I would say cryptocurrencies kind of took our lunch for a little while, but I think people are realizing there's a lot of air in that. There isn't anything really physically backing that. And there really are no barriers to entry into the cryptocurrency game. Whereas gold is very, very finite in quantity. There's a very limited amount of it on the Earth's surface, and there's very little of it being produced.
Well, I think that hits home today because we are seeing a correction in the cryptocurrency market as a whole. But with what you just mentioned with respect to the state of the economy, do you think that's going to provide a good floor to the gold price kind of going forward?
Yeah, look, I don't see interest rates coming up anytime soon. I don't see an end to quantitative easing anytime soon. I think this is a hole that's going to take a long time for us to come out of. I do think there's going to be a massive correction in the general equity markets. The valuations we're seeing there are stretched beyond recognition. There's going to have to be some sort of correction there, and that will result in a massive amount of capital being allocated to gold, which has always been seen as a safeguard of capital in turbulent times.
Now, one of the things that I did observe that you guys have nicely presented on your corporate presentation is the gold reserves that are in majority of the companies these days, and how drastically it's come down over the past 8 to 10 years. Do you want to talk a little bit about that?
Yeah, certainly. I mean, the industry's never been this ill-equipped to enjoy the rise in the gold price. From the standpoint of reserves in the ground, production, both of which are in a steady state of decline. We've seen reserves come down 40% over the last 7 years, simply because the industry has not reinvested back into exploration in any sort of meaningful way. Until recently, maybe a year ago, juniors couldn't even raise any money to save their lives. They couldn't raise capital, put money into the ground. Well, that's become an existential issue for the industry. If the juniors aren't being successful in discovery, then we have nothing to fill our pipelines with as producers and to replace our depleting reserve bases. And so the industry is focused rightly, I think, initially on profitability, deleveraging, because we had quite a party 10 years ago when gold was last through $1,900 an ounce, and the industry allocated massive amounts of capital to mine construction that inflated costs dramatically. We saw operating costs inflate, capital costs inflate, and we saw that on the base metal side as well. There was, we were in the middle of Chinese super cycle, and so we saw base metal companies build up new capacity as well. So the industry strapped on a lot of debt and left shareholders disillusioned because they didn't experience the leverage to the commodity price they were expecting in buying the mining equities. And so the industry focused on deleveraging, returning dividends to shareholders, buying back stock, and maintaining stable cost structures so that they could see their margins improve as the metal prices increased. And that's happened. They did a great job. And the gold industry right now has net zero debt. In my 30-odd years in the mining industry, that's never happened. So they've done a great job of reconditioning their balance sheet, of returning dividends are great in the gold sector right now. You buy a gold stock, you get 2-3% yield typically from some of the mature and more senior producers. That's fantastic. So clearly these are well-run businesses that are profitable, but what they've sacrificed to do that is exploration. They haven't invested meaningfully in that, and they've lost the art of mine construction. There hasn't been any major mine development, particularly in the gold sector, for 6-7 years. And the result is inevitable. The reserves go down, production declines. And so the leverage that we provide in the ground and our production profiles as an industry to the gold price has diminished dramatically. And so what I think will happen is we'll repeat the same phenomenon we had 10 years ago. I think mining companies are going to have to allocate significant amounts of capital to new mine construction, and they're going to have to take on a bit more leverage, but we're going to see cost inflation again. As we're seeing inflation in the general economy, we're going to see cost inflation, operating capital costs. And that's why I think it's very important for mining companies that have capital lined up to build out new capacity and to do the exploration they need to do to replace their depleting reserves.
So that hits home for me because, I mentioned briefly before we started the interview, I work in oil and gas. And so we deal with this inflation of costs and deflation of costs as the oil price goes up and down as well. So definitely hits home for me. I feel like we're going in a similar cycle with respect to oil and gas right now, where exploration has been extremely light. They've been focusing on returning money to shareholders. And now that we are starting to get back to exploration, you're starting to see the inflation of costs again. So right now would be a potentially good time to get those margins, but you might be saying in the future, unless the gold price continues to go up, that those margins might continue to shrink again as folks continue to do exploration and try to get the reserves numbers up, just like they had back in 2012 time period. So that's really good insights. Okay, so taking what you've kind of just mentioned and relating it to how you obviously have been a huge proponent in junior mining companies, senior mining companies. What's different about Gold Royalty that will help you guys work through this cycle and have more of a steady stream of cash flow comparatively to, say, a junior mining company or a senior mining company?
Well, I think I should maybe take a step back and talk about the importance of royalty companies to the ecosystem and why we've seen a proliferation of these royalty companies come to the market over the last couple of years. When there's massive mine construction, when we actually start to see the industry allocate capital to exploration and development again, royalty companies have always provided a meaningful and important source of cheap capital for the producers in order to do just that, to explore, develop. And so that's why we're starting to see capital come into the royalty companies, and why, frankly, I'm positioning myself at this point in my career at that end of the spectrum. In other words, acting as a bank for mine development. That's how I see royalty companies participating in this new phenomenon of mine construction and exploration, which inevitably will have to happen to replace those depleting reserves. And what's unique about Gold Royalty is that it has a significant mineral endowment that we've inherited through the spin out from our parent company, Gold Mining Inc. We IPO'd back in March. Gold Mining Inc. still owns 48% of us, but we were able to raise $90 million US in the market. And we enjoy a 26 million ounce gold resource underlying our royalties. We have 18 royalties on those properties across the Americas. And that's an important element of building a royalty company. And that, in fact, among the sub $1 billion market cap royalty companies, we have by far the largest mineral endowment. We also have the largest cash balance on the balance sheet, given how successful our IPO is, and we have no debt. So we have both a foundational element in terms of the reserve and resource we inherited from gold mining, but we also have a significant treasury that will allow us to diversify into other royalty opportunities as we expand our business over the coming months and years.
Yeah, so at least at the moment, talking a little bit about the market capitalization of the organization, it's around $190 to $200 million right now. You guys have about $85 million on the balance sheet, if I remember.
Yeah, just
correctly.
under 90 million US, which is what we raised in the market. We haven't allocated that capital into new royalty opportunities yet, but we're actually quite active looking at them right now. I'm very confident we're going to have a steady stream of deals over the next year or two and put that capital to work with a view to getting at least double-digit rates of return on the capital we invest.
And so once you guys, obviously you just IPO'd, you mentioned back in March, do you have a plan eventually to release some of the capital that you guys might be receiving in terms of the streams that you're going to be getting to shareholders as dividends in the future?
Yeah, that's the plan. I mean, all 18 royalties we have right now are on development stage properties, so we currently don't have any cash flow, but we will be placing a premium on getting cash flowing assets into the portfolio in the next several months as we start to diversify our portfolio. And once we establish a steady state cash flow, what's great about the royalty business is eminently scalable. We have literally a handful of employees, and we don't need to add significantly to our headcount to grow our business substantially. And so that means G&A costs stay low, and as our cash flow grows, it gives us the capacity to look at returning capital to shareholders on a systematic and steady basis.
So you're eliminating, you're basically exchanging part of your capital in order to get an ownership in the mine, reducing your operational risk, because obviously you don't have any participation in the operations. You're not partnering, you're just becoming owner, which obviously you don't have any particular working interest. You have an overriding interest in in each individual mine. So that's very interesting and something that I'd like to explore in the future as well. Is there any other things that you might be exploring in terms of expanding on the business or?
Well, I can talk about the royalty business generally. And what I would say is the business is very, very simple. We're providing capital to developers, explorers, and even emerging producers, and taking a royalty back in return. And so effectively acting as a bank. And when we put that capital in, we're doing so with an expectation of return, and the form of that return is a royalty. In other words, it's a percentage of the revenue. Typically, it's 1% to 2% of the revenue in a typical royalty structure. And as the gold price goes up, we get the full benefit of that. So we have full leverage to the gold price. And as the partner company, the operator, explores their deposits, grows them geologically, we get the full benefit of the exploration upside as well. Mm-hmm. So it's almost like owning an ETF, a gold ETF, but with exploration upside.
Yeah.
And as you correctly pointed out, we're insulated from capital and operating cost risk.
And inflation and all that. Yeah, the inflation and costs.
That's the beauty of the business. Yeah, we're insulating our shareholders from that risk. So if you buy an operating company, certainly you get the leverage to the gold price, you get the leverage to the exploration, but you also get exposure to the risk underlying operating capital costs. And as I said earlier on, I think there's going to be massive inflation on operating capital costs again. There has to be. We're starting to see that on the exploration side. We're starting to see drilling companies start to consolidate because business is picking up. They have capacity constraints. And so I think we're going to see drilling costs go up, and we're going to see operating capital costs go up. And the royalty structures insulate you from that. They give you the gold exposure, they give you the exploration upside, but without any of that operating costs and capital cost risk.
Mm. Now, it's a very interesting business model. I've been curious about others, specifically in the oil and gas industry, but also the gold industry as well. So it's definitely something that I potentially will be looking in for sure. Are there any major catalysts associated with Gold Royalty Corp or anything kind of going forward that you'd like any of the viewers to kind of listen to, or just folks that are interested in gold in general to kind of think about?
Yeah, look, we're going to be very active in the space in terms of buying new royalties. I think you should expect to start to see us invest some of that capital we've raised back in March when we closed our IPO, and we'll start to add to the portfolio, start to bring some nearer term royalties into the portfolio with nearer term cash flow and with very high rates of return. So we'll start to put that capital to work for our shareholders. We've been entrusted with their capital, and we expect to allocate it, getting strong rates of return on that invested capital.
So is there a minimum gold price that you're kind of looking at with respect to a lot of these different organizations or mines that you have ownership in, where you guys potentially would not have any sort of money kind of coming in, or because you guys are part owner, you're always going to have that money stream coming in because you don't have that operational constraint risk?
Well, that's exactly right. It doesn't matter what the margin of the mine is, because our exposure is entirely at the top line. It's at the revenue line. We get 1% to 2% typically of the revenue. In streams, quite often you're taking physical delivery of the gold. We haven't done any streams yet, but that's certainly within our mandate to do so. So no matter what the condition of the mine is, the level of profitability will always get our share of the revenue.
Awesome. So you don't have to worry about any sort of break-even costs or anything of the like. Well, that's interesting. Is there any other questions or anything else that you'd want to follow up on any of these questions? I think.
No, look, all I would say is if investors want to learn more about Gold Royalty, we're at goldroyalty.com. Our trading symbol on the New York Stock Exchange is GROY. And the stock is held in very, very well since the IPO. We have strong currency, so we're in a very good position to put our capital to work and start to support the industry as it enters a development and exploration cycle that's obviously extremely important for it to sustain its businesses.
Lastly, I want to just thank you so much, David, for joining us. I mean, you have an impressive resume. I hope folks take the opportunity to look at GROY and the great opportunity that you guys have here that insulates them from inflation costs associated with the operations of the business, and a steady stream of income and potentially dividends coming down the pipeline coming from the company. So thank you so much for the opportunity to talk to you and also to talk about Gold Royalty Corp. Thank you so much.
Thanks for having me on, Matt.
Absolutely.